Hey everybody, welcome back to the Market Interest, where we talk stocks, finance, and the markets. Does anybody else feel like we are in a market crash right now? No matter where you're turning, you're seeing stocks going down. Everybody's being impacted, and let's be honest. If we take a look at the year-to-date returns of companies, it's a mess. It's a bloodbath over here. Every stock on this list here is practically red. Looks like energies are doing fairly well. They've been holding up over here. The energy market, financials are doing well, standing behind me. But overall, year to date, the performance of the market's really not doing too well, and it's scaring a lot of people. I hear it every single day. People saying, I think the market's crashing. The market's crashing. What's happening? Just look at like some of the major tech stocks that we have out there. Amazon is down 7.5%. This is after their huge performance that they just had last week. Massive return on Friday. But year to date, they're down 7.5%. Microsoft down 9%, Nvidia down nearly 20%, Tesla down 23%, Facebook down 30%, Netflix down 30%, PayPal down 35%. There are massive losses or corrections happening right here. A lot of people own these stocks. These aren't just like, little no-name stock. These are the big ones. These are the big boys. And if they are down, this is going to drag down all the indexes or mutual funds, all the other portfolios, the S&P 500. They're all feeling this. And we are, as investors, a natural reaction is just, my gosh, the market's got to be collapsing. Things going down so much. The market's crashing. The market is crashing. And I think people have a good point. That you see such a big correction in the market. You see a lot of things moving at once. It's natural to be worried about your portfolio, about your assets, your retirement funds. You guys are working really hard to save your money, and then have it have such a large impact in such a short period of time. It's very understandable. Switch this over to the price to earnings multiple of companies, where right now you're seeing a wave of red, which it means there's an overvaluation, a lot more than what it probably should be for some companies, not all of them, but for some companies. So I think there's a natural concern, what's going on with the market, where should we be investing money? If you're starting to see so many companies have inflated prices, inflated multiples, and then, hey, we get to 2022 and all they're doing is going down really. Anytime there's a market pullback, it's natural to be worried and to feel like the market is crashing. The market's, never going to recover. But do I think this is an all-out market collapse and the market's going under, or these companies are going under? Definitely not. I am not in that in that ballpark. I think this is a natural cycle of companies doing really well and being really hot, an economy being, really strong and growing, and just companies become overvalued. It happens naturally. And then eventually what happens is they revert back to their mean, to a normal multiple, and they're fairly priced. And what I think is happening right now is we're starting to see a lot of the corrections happening in real time, where stocks are starting to plummet back to where their price to earnings should be, going back to just a normal valuation. I think it's really important to put things into context. We go to a 1-year performance and just look at how the market's done over a 1-year period of time. You see there's been a lot of really good performing stocks. Overall, the market's done really well over this 1-year period of time. But we're having some type of correction, getting back to where things probably should be. I think it's really important to keep that one Wall Street saying in mind, where they say, bulls make money, bears make money, but pigs get slaughtered. So I think one of the best ways to avoid being one of those pigs is really by diversifying your portfolio. I've been doing it for myself, shifting from just growth-oriented stocks, getting into more value-oriented stocks, companies that are being overlooked, undervalued, and doing the same with all my clients as well. Looking for different areas, different pockets of the market that seem to have a better upside potential, or just broaden the diversification in their portfolios, broaden the risk spectrums in their portfolios. That way, you're not being too greedy in just one area and really going to get whapped if something bad happens, So diversification is key. If you've been investing in a couple of sectors or stocks, companies that have just been doing so well, and you have made a lot of money from it, you have to think, take a step back It's hard to do, but leave your emotions at the door, take a step back, and really think to yourself, hey, is it logical that this company is going to continue doing so well for another, year, 2 years, 3 years? Now, I'm not saying that it's impossible. There might be a really good company that is going to do that. But what I've noticed is that there's some higher level of risks associated with just having growth stocks. And I think a lot of the earnings that have been showing up in the last week or so show that companies aren't justifying the price of their stock. What I want to do is break down one of these companies for you and go over some of the details and share why I think this is a good opportunity for somebody who is looking for an undervalued stock, who's okay with some volatility. They're used to the growth-oriented stocks and having more volatility. This type of company isn't appropriate for everybody, but the investment could be appropriate for somebody who is looking for some higher growth opportunities, doesn't want to get stuck in the mud with just being in tech, wants to diversify out a little bit more into something more industrial oriented, and still have some profitability measures associated with their stock. All right, this company here is Star Bulk Carriers. They are more of a mid-cap undervalued stock, mid-cap value stock. Their market cap is $2.3 billion, about $2.4 billion. And just looking at some of the fundamentals quickly before we dive into the rest of the company. So their earnings per share is $6.43 per share. Their stock price is about $24 per share right now. So there's a significant portion of their value is coming right from their earnings, and which would convert into a lower multiple. At a multiple of 3.71 for their price to earnings, which is really low compared to a lot of these other companies out there, especially in the tech stocks. They're up in the high teens, 20s, 30s, 100s even. They're paying a dividend $5 right now, and they have a yield of 21% for that dividend. So that's awesome. That's impressive. If we check out their website real quick, nice website here, Star Bulk. They own a fleet of ships. What they do is just they ship solids from one country to another. That's it. Really boring. But guess what? We all need stuff. We have all these, shipping containers backed up on the oceans or stuck in a canal, and they can't get products off it. This is one of those companies, guys, that are shipping product from one country to another. If we check out what they actually have on the water, this is pretty cool. It shows the different types of ships that they have. So just give yourself a little background in terms of, what type of equipment they have and what type of company you're investing in if you decide to. Just shows how many ships they have, what type of ship it is, what they can actually carry. Check it out if you're interested in the company. Now, so far year to date, they're up about 5%, which is good. I think that's a nice steady place to be after a month. If we look over a 1 year period of time, they had some fantastic returns. I would not expect this moving forward, but still good growth opportunity. In the last year, they're up 116%, which is fantastic. Like that's not blowing it out of the water, no pun intended. So they've been overlooked for a while, which is really where the main point I'm getting to is, they've been overlooked as a company. They're not exciting like a Facebook. They're not exciting like Amazon. They're a company that just moves stuff from one place to another. That's it, but we all need it. And it's really valuable to all of us. Let's take a peek at one of their most recent corporate presentations, and just gives a quick overview. So their fleet size, I think they have 128 ships, high quality vessels. They have them for about 10 years so far. They've got some of the biggest fleet size compared to their peers, which is great. Their balance sheet looks very strong. They have a really strong dividend, which is something they, like to brag about, which is good. I like that. I'll scroll down here. So I thought this was pretty cool. And let me get my big head out of the way here. I thought this was great to see, is that their average daily operating expense is much lower than a lot of their other peers. So if they're able to deliver more goods, products, services, whatever it is, and still be able to do it at a much lower cost, then it makes sense for everybody. More people are going to be using them as a service provider. They're able to deliver more value to their shareholders, especially anybody that's investing in their stock, by paying out a really nice dividend. So they're really doing well in terms of their operations, running it very efficiently. They also have continued improvements from their balance sheet, so they really dropped down in terms of their net debt, 35%, which is awesome over the last couple of years, really. And then they also increased the amount of cash that they have on hand. It seems like everybody's had more cash on hand the last couple of years. Obviously, all the stimulus being passed out everywhere, but it comes back around to everybody, really. But yeah, since 2019 up to 2021, they increased it 277%, their cash and liquidity. So that's awesome. That's something that you really want to see with a company, especially when times are shaky. You're really not sure if like the economy is going to be doing well or the market's not going to be doing well. You want to look for a company that has a lot of cash on hand. All right, so let's take a peek more at their fundamentals a little bit more. So take a peek at just their profitability measures. Looks like gross profit margins. It's awesome, 60%. Net income margin, that's key. That's 37% compared to their sector median at 7%, 6.5%. All these look good except for some of the turnover ratio. I mean, the whole industry's been having troubles with turnover. All right, so just looking at their income statement, you can see that they have had a really nice trajectory of revenue. The most recent year is going to be on the far left, and then moving back in time over towards the right. So you can see that their revenues are increasing, pretty substantially. And I think they have some more earnings popping out for coming up soon, actually. So total revenues look solid, really good improvement. Gross profit, that's taken, these are multiplied over the years. That's great. We just want to make sure that that can stay, if that's sustainable. We want to make sure that's sustainable for even just a handful of years, and that gives us enough time to invest in the company and reap some of the rewards from it. Now jumping onto their balance sheet, looks like their cash has increased as they actually showed in the other presentation, but their cash really has boosted a lot. Total cash and short-term investments looks great, pretty much same as cash. Accounts receivable is steady and increasing over time. Just don't want that to get too out of control. So total receivables. All right, just want to make sure that they're not hanging on to the receivables for too long. You want to actually receive cash. Total current assets looks good. They've really done a great job since 2013. For their current liabilities, that stayed, it's gone up. It has gone up a little bit over time, but total liabilities, when you look at the actual numbers, it's not like a huge increases over time. They've been pretty steady, yet their net income has increased, their balance sheet has increased, and it looks like their debt it's increased slightly, but it's not like massive amounts. It's been pretty flat for the last 4 years, 5 years. So I like that. Just seeing that they're able to control how much debt they actually have, still collect more equity, more income, and they're paying out a strong dividend, and still be able to pay all their liabilities. That's great. All right, so an A+ grade from Seeking Alpha, but let's dive in a little deeper. Their price to earnings ratio, non-GAAP, again, you're looking in the threes. So GAAP forward PE is 4.2. That's incredible compared to what else is out there in the markets right now, guys. That's it. It's such a lower price to earnings, and they're generating a ton of cash and a lot of net income, paying a huge dividend. The low multiple doesn't even make sense to me. Why it would be this low? I don't think enough people have seen it, have seen the company. Either not looking in the sector, or just too many people are attracted to the big tech stocks and growth oriented. But it's a good opportunity. I own this company. Full disclosure, I do own this company. Have owned them for a little while now. So yeah, full disclosure. Price to book value looks pretty good. And price to cash flow. I think that's more important actually than price to book. Personally, I like to know that company has enough cash, and based on where their price is, are they able to reap in the benefits? Are we able to reap in the benefits from their cash flow? And is there enough cash flow to keep them secure, keep them alive as a business? So yeah, this looks pretty solid. So yeah, just another good company to keep an eye out for, and instead of just being focused on just tech stocks or growth stocks, shifting into another area of the market that still has a lot of potential to grow, a lot of potential to produce income. They have good net income, a company that's undervalued, overlooked, that's paying a dividend, a really strong dividend. What was that, a 20% yield on a dividend? Like, just insane. Just insane dividend. Those types of opportunities, I think, are going to be much more attractive and much more beneficial to investors within the next year. I think there's a lot of movements going around. I think there's a lot of talks about market crashes. I think we're in some type of correction just based on where multiples are with all these companies. You know, their multiples are through the roof, guys. The 30-year or 25-year average is somewhere between like 16 and 17 on average. So the fact that they're up into like high 20s, 30s, 40s, 50s, even a couple hundred for some of these companies doesn't make sense. It's a dangerous place to play at times. And it's not always justified for them to have a price that's so high and their multiples to be so high. So instead, I encourage people to diversify more. Look for some more undervalued stocks. Look for a stock that is undervalued, that people are overlooking. It might not seem that attractive in terms of their story. I mean, heck, we're just talking about a bunch of ships right now. We're not talking about AI and cool things and the metaverse. We're not talking about any of that. We're talking about stuff that has to move over here to over there. That's it. But they're making a truckload of cash. They're doing a really good job with their operations, and they're paying a massive dividend compared to a lot of these other companies. So even if their stock fluctuates a little bit, at least they're getting paid a dividend in the meanwhile. When a lot of the growth companies, you aren't collecting any dividend. A lot of them, you're in it for the ride. So this is a way to diversify, broaden your investment portfolios a bit more, seek out those other opportunities that are just being overlooked, and start to capture on those. If you guys have any questions about your personal portfolio, or if you want to know if this is an appropriate stock for you, feel free to reach out to me. I'm more than happy to. I'll leave a link in the description below. And feel free to reach out to me. We can set up a free consultation, but it might be worthwhile looking into a few other opportunities like this. Feel free to reach out, or don't forget to share, subscribe. Don't forget to like the page, share, subscribe if you're getting any value out of this. And then join any conversation on Facebook. Our Facebook page is The Market Interest. So check us out there. We can have a conversation. Unfortunately, we can't on YouTube due to some compliance issues, but right on Facebook, we're allowed to hear. So. All right, look forward to seeing you guys soon. Take care.